Hello, Bob Wazorek again. We're going to look at continue our discussion on equities. In this particular segment, we're going to look at indexes. So equity indexes. Let's take a look. Okay, so why do we need to know this? Well, frankly, our clients expect us to know it, and it's also relevant to benchmark construction. So we need to know a little bit about the indices because the indices end up being our benchmarks. Our fund performance is typically compared to these benchmarks or these indices. So we want to be at least conversant in what they are. So let's take a look. We'll look at some global indexes, the S&P 500 in particular. I'll look at how that might contribute to portfolio construction and look at active versus passive portfolio construction, and then briefly sort of how we might describe different types of equities from a sector standpoint. So not just whether they're healthcare or automotive or banking, but then sort of how we might characterize those in terms of being defensive or cyclical type securities. So let's get to it. Stock indices. Okay, well, we've already said this. We use them to benchmark the fund performance. We also use them to construct index portfolios or any sort of passive management. Okay. This way we know what is actually in the portfolio because the portfolio just replicates the index, and the index information is generally available. Not always available, but generally available. This also used as a tool to gain a sense of market influences on security prices. Okay, so this is that beta discussion again. Beta keeps coming up over and over again, and this is looking at the relationship between the market as described by an index and beta and the particular security or portfolio that we're evaluating, and the relationship, the linkage between them that we're referring to as beta. Also, market technicians. We talked a little bit about technical analysis. Well, a lot of times people are looking at indexes to determine whether the market as a whole is feeling relatively strong, relatively weak, is overbought, oversold, those types of things that would be other applications or uses of indexes. So let's take a look at a couple different indexes from around the globe. So we've got the first one is the Zentra DAX. What country is that from? DAX is in Germany, which hopefully I'll check the right box. I think that one is Germany right there. So there's our DAX. Next one, the CAC 40. That is France. So put that one right there. There's good old Paris. The Nikkei 225. Okay, that is Japan, which we'll say over here. Japan is our Nikkei 225. Hang Seng is Hong Kong. Okay, the FTSE 100, that's in London, over here. Okay, in the UK, so the FTSE 100. S&P 500, hopefully that's familiar. That's right here in the good old US of A. I'll put it down as being in New York as the financial capital of the world. Dow Jones Industrial Average, also U.S. NASDAQ 100, also U.S. So we have a broad market indexes for the S&P 500, the Dow Jones Industrial Average, and the NASDAQ 100, all U.S.-based indexes, but they're all slightly different. We'll talk a little bit about some of those differences. The OMX, that's Sweden, so that's over here in Scandinavia. And the next one, New Zealand, we'll say that's New Zealand. Forgive my geography. Okay, well now let's look at the indexes a little bit closer. So this is the S&P 500. Now we said for the US, there's lots of different indexes, but we had already talked about S&P 500. Then we also mentioned the Dow 30, and then also the NASDAQ 100. Okay, now these indexes are all different. Well, S&P 500, as the name suggests, is 500 large cap U.S. equities. So the criteria that S&P uses to select them is proprietary, but basically what they're doing is they're looking for large cap liquid securities that are representative of industries here in the United States. Okay, the index does have subcategories, which we're going to look at in the next page, but importantly, it does include financial service firms. So the S&P 500 does have financial service firms within the index. That contrasts to something like the NASDAQ 100, which, as the name suggests, is 100 securities. That's the 100 largest non-financial market cap companies traded on the NASDAQ. So that would be companies like Oracle, Apple, Microsoft, Intel, large cap companies traded on the NASDAQ that are non-financials. So again, we just have to know that if we're looking at comparing the performance of the NASDAQ 100 with the S&P 500, yes, they're both U.S. equity indexes, but they're going to behave slightly differently because of the way or the methodology in which they were constructed. The Dow 30 is an old style index, probably not nearly as popular from an institutional standpoint, and this is probably pretty relevant information for you guys, because the Dow 30 is what we call a price-weighted index. So it's weighted by the market prices of the stocks that comprise that index. It's a very antiquated way of composing an index. The NASDAQ 100, the S&P 500, the FTSE, any modern index is going to be what we call market cap weighted by the size of the equity value of that particular business. So the Dow is a bit more of an antiquated index. It's frequently spoken of because it's the Dow Jones Industrial Average. Dow Jones publishes a newspaper called the Wall Street Journal, very popular financial periodical in this country. So the Dow 30 is very frequently referred to on the 6 o'clock news. They always say the Dow did this, the Dow did that. But financial professionals are going to be more keenly focused on the S&P 500 as the predominant benchmark for U.S. large cap equities. Okay, so that's the S&P 500. It trades at points. So here it says at the time the screenshot was taken, it was trading at 1374. I'm pleased to report that as we're having this conversation, it was at 1459. So yeehaw, go USA. So the index has been on a bit of a move so far this year. Always pleasant to see that. But nonetheless, the way we refer to this is at the time this was taken, 1374. Right now, 1459 points. So it's index points. There's no dollar value associated with that. It's a mathematical calculation in an Excel spreadsheet based on the stock price of those 500 names, weighted by their market capitalization, and then put together in this index. Okay, here are some of the sectors that are reflected in the S&P 500 index. So you can get a sense of, we've got integrated oil and gas, we've got pharmaceuticals, we've got computer systems, other, integrated telecom, aerospace and defense, industrial conglomerates, oil and gas exploration, soft drinks, semiconductors. You get the idea, a whole bunch of different industries, a whole bunch of different sectors that comprise or make up the total S&P 500 index. And so the whole idea, again, is the index was specifically chosen or designed to be representative of the broad U.S. equity market. How might this be applied in asset management? Well, if I'm a passive manager, well, it's quite straightforward. Well, what I do is I look at the construction of the index and I simply replicate it. So the things that are actually in my fund or in my portfolio, you can see directly mirror the weightings in the index. So there's no analysis of a good stock or a bad stock. It just, if it's in the index, it's in my fund, and it's in the fund in the same proportions as it's in the index. Okay, that would differ from an actively managed fund. So if we had an actively managed fund over here, well, you can see that the weightings between the index and the fund are different. So in this case, we would say we're overweight. In this case, we would say we are underweight. In fact, we've got no weighting. That's very unusual that we'd have completely avoid a stock. But here we would certainly underweight something. So we can go underweight or overweight a particular, the particular components of that benchmark. We're not trying to directly replicate the benchmark, and that's what we see here. And that would be if we're an active manager. Okay, other characterizations of stocks, we might refer to them as being cyclical or non-cyclical. So we would look at different sectors and describe those sectors and the stocks included in those sectors as being or having a tendency to be more cyclical or non-cyclical. So let's take a look. Examples of stuff that should be non-cyclical, or sometimes referred to as defensive stocks, would be things that would typically continue to go on and be sold regardless of economic conditions. Okay, and everything is within reason or within degrees. So this is what we would expect to see under most scenarios. I'm not saying that this is an absolute, but under most scenarios, you would expect things like tobacco to continue to be smoked. You would expect household non-durables, food, that type of things, consumables to continue to be consumed. You would assume healthcare will continue on. If you need to go to the hospital, you're going to go to the hospital regardless of economic conditions. Energy, well, we might conserve energy, but typically we're still going to use lights and heat and those types of things regardless of the economic climate, or at least there's some inability to sort of just shift to sunlight and then go to bed during the winter at 5 o'clock when it gets dark. We're probably still going to turn the lights on. Cyclical stocks would be things that tend to be highly exposed to economic cycles. So things like leisure, travel, auto industry for sure, construction, industrials, financial service companies tend to be very cyclical stocks. So they tend to do very, very well during an economic expansion, and those stocks tend to come under pressure during times of economic contraction or economic slowdown. Okay, so what did we learn? Okay, we learned about the major global indexes, okay, where they are in the globe, or approximately where they are in the globe, given my geography. And then we also talked about the S&P 500, how it's constructed. That's market cap weighted. It's a modern index as compared to the Dow, which is price weighted, which is a bit of an antiquated methodology. We also looked at how indexes might get applied in asset management from either a passive manager who's going to use that index to replicate it, or an active manager who might go underweight or overweight different components of an index, might still be benchmarked against that index, but the actual portfolio construction would be slightly different than what the actual index is. And then we talked about equities as being either cyclical or non-cyclical, or when we say non-cyclical, the potential for those securities to be defensive plays. Again, thanks for your time. It's Bob Wazorek, and I'll see you on the next segment.